September 2008. One of the most powerful banks in the world vanished overnight. Not hacked, not robbed, just gone. $600 billion evaporated. Millions of people who had nothing to do with Wall Street woke up with empty retirement accounts, pink slips, and mortgage payments they could no longer make. And the most insane part? The whole thing started with a lie so simple it fit on a bumper sticker. Why rent when you can own? This is the story of how greed, bad loans, and one giant house of cards brought the global economy to its knees. Rewind to 2002. America is shaken. The dot-com bubble just popped. The September 11th attacks rattled the economy. The Federal Reserve had one move: slash interest rates to near zero. Cheap money meant cheap loans, and cheap loans meant everyone suddenly wanted to buy a house. Not just people who could afford one. Everyone. Banks started handing out mortgages like flyers outside a nightclub. Bad credit? Fine. No job? Fine. No down payment, no documentation, no problem. These were called subprime mortgages, loans given to people who, under any normal standard, would never qualify. The banks knew the risk, they just did not care, because they had a plan to make someone else deal with it. And underneath all of it ran one shared assumption, so widely believed it barely got questioned: housing prices always go up, always, until they did not. Here is where it gets interesting. Banks did not sit on those risky loans. They bundled thousands of them together, wrapped them up, and sold them to investors as securities, safe investments, AAA rated. How do you make a pile of bad loans look like a safe bet? You get a ratings agency to stamp it approved. And here is the catch: the ratings agencies were being paid by the very banks they were rating. It is like hiring someone to review your restaurant, then telling them you will only pay them if they give you 5 stars. Wall Street called these bundles mortgage-backed securities. Investors all over the world bought them. Pension funds, insurance companies, foreign banks, everyone wanted a piece. And then Wall Street went a step further. They took those bundles, mixed them with other bundles, sliced them into layers, and sold the layers. They called the result a collateralized debt obligation, a CDO, which is just a complicated way of saying nobody really knows what is inside this thing. The whole machine was spinning, loans being written, bundled, rated, sold, repackaged, and sold again, faster and faster, and at every step, someone was collecting a fee. By 2006, cracks started showing. Home prices, which had been rising for years, started flattening, then falling, and the loans that were written assuming prices would always go up started going bad. Borrowers who could barely afford their payments when rates were low suddenly faced adjustable rates kicking in. Payments doubled, people defaulted, foreclosures spiked. The securities built on those loans started losing value, then losing a lot of value. Banks that had loaded up on them suddenly realized their balance sheets were full of garbage. In 2007, it was a slow bleed. By 2008, it was a hemorrhage. Banks stopped trusting each other. Nobody knew who was holding what. Credit markets froze. The whole financial system, which runs on trust and lending, effectively stopped working. And then on September 15th, 2008, Lehman Brothers filed for bankruptcy. 158 years old, gone in the morning, $600 billion in debt. No bailout, no rescue, just collapse. The message it sent was simple and terrifying. If Lehman can die, anyone can. What happened on Wall Street did not stay on Wall Street. It hit Main Street like a freight train. 8 million jobs vanished. Unemployment hit 10%. 4 million homes were foreclosed. $19 trillion in household wealth disappeared. Not Wall Street wealth, regular people's savings, retirement accounts, home equity. Gone. Families that had done everything right, paid their bills, saved their money, suddenly owed more on their homes than those homes were worth. Businesses could not get loans to make payroll. Retirees watched decades of savings get cut in half in weeks. The government stepped in with $700 billion in bailouts, the Troubled Asset Relief Program. They propped up the banks. They rescued the insurance company AIG with $180 billion. They bailed out car companies. The banks that caused the crash got rescued. The people who lived through it got nothing. Not a single major Wall Street executive went to prison. No handcuffs, no trials, just golden parachutes and quiet retirements. And people were furious. In 2011, thousands occupied Zuccotti Park in New York. The signs read, "We are the 99%. It was not just anger about money, it was anger about a system designed to protect the powerful and abandon everyone else. The 2008 financial crisis was not a natural disaster. It was not bad luck. It was the predictable result of greed, bad incentives, and a system where the people taking the risks were not the ones who would pay for them. The loans were reckless because the people writing them were not keeping them. The ratings were fake because the agencies were paid to make them fake. The bets got bigger because the people making them knew someone else would cover the losses. Every financial crisis in history has one thing in common. Somewhere, someone convinced themselves that this time was different, that prices would keep rising, that the debt was manageable, that the risk was contained. It never is. The next crisis will not look like 2008. It will look like an opportunity. It will feel inevitable. It will seem safe until it does not. Stay curious, stay skeptical, and maybe, just maybe, read the fine print.